Hey everyone, welcome back to Corporate Decoder, the place where we break down the financial secrets of the business world. And let me tell you, Conduent's latest report is a real page turner with some big shifts happening. Before we dive deep, if you love getting these no-nonsense financial breakdowns, hit that subscribe button and the notification bell. You'll be the first to know when we decode the next big company. Also, we've got a fantastic community over on Discord where we discuss these filings in real time, link in the description below. So join us there. All right, let's jump straight into Conduent's financial performance for the second quarter of 2025. It's a bit of a mixed bag this time around. Their total revenue really took a hit, dropping from $828 million in the second quarter of 2024 down to $74 million in the same period this year. That's a pretty significant 9% drop. Now you might think, okay, revenue is down, but maybe their costs also went down, right? Well, not so fast. While some costs like selling general and administrative expenses did decrease, their total operating costs and expenses actually shot up from $528 million to a whopping 710 ok NUH CAS also went down, right? Well, a major reason for this cost surge is this line item here, gain loss on divestitures and transaction costs net. In the second quarter of last year, they had a massive gain of $347 million from selling off parts of their business. But this quarter, they recorded a positive $4 million cost, meaning they spent money on divestitures instead of making money. This swing alone is a huge factor in why their total costs went up so much. And the bottom line, the net income or loss reflects all of this. Last year for the second quarter, Conduent reported a healthy profit of $216 million. This year, they've swung to a net loss of $40 million deterioration. It looks like the cost of selling businesses and other adjustments are really weighing them down this quarter. Looking at the first 6 months of the year tells a similar story. Revenue dropped from $1,749 million, a decrease of 14%. And again, total operating costs and expenses ballooned from $1,399 million, this along with the absence of those big divestiture gains from last year, led to a net loss of $91 million this year, compared to a profit of $315 million last year. And to $59 last year. Let's shift our focus to their balance sheet, which is like a snapshot of what the company owns and owes. On the asset side, you can see their accounts receivable, which is money owed to them by customers, decreased from $493 million at the end of last year to $458 million now. That could mean they're collecting money faster or simply selling less. Their goodwill, which represents the premium they paid for acquisitions over the fair value of identifiable net assets, actually increased slightly from $609 million to $617 million. This suggests they might be making new acquisitions, or the value of existing ones has gone up, but without more context, it's hard to say if this is a good or bad sign for future growth. On the flip side, their total current liabilities, which are the bills due within a year, have decreased from $744 million to $640 million to $697 million. This is generally a positive sign, indicating they're managing their short-term obligations better. Overall, their total liabilities and equity stand at $2,488 million as of June 30, 2025, down from $2,599 million at the end of last year. This reduction in their overall financial obligations is another positive point on the balance sheet. Now for cash flow, which tells us how much actual cash the company is generating or spending. For the first 6 months of 2025, Conduent used $73 million in operating activities, which is a bit worse than the $78 million they used in the same period last year. While both periods show cash being used rather than generated from core operations, this $5 million increase in cash outflow isn't ideal. The big story in investing activities is the massive drop in proceeds from divestitures. Last year, they brought in nearly $600 million from selling businesses. This year, that number is only $53 million. This clearly shows they've already sold off the major parts of the company they intended to. Financing activities tells a similar tale. Last year, they used $681 million, mostly to pay down debt and buy back stock. This year, that number is down to $30 million, which makes sense given they've already done a lot of that. Revenue in their commercial segment, which is a big part of their business, saw a decrease from $807 million in the first 6 months of 2024 to $767 million in 2025. That's a 5% drop. And what's really concerning is that their profit in this segment also fell from $33 million last year to just $23 million this year. This, combined with a drop in adjusted EBITDA, suggests they're facing some real challenges in their core commercial business. Their government segment, however, showed some resilience. Revenue decreased slightly from $503 million to $450 million to $77 million, and their adjusted EBITDA also improved in the second quarter. This segment seems to be navigating the tougher environment better. The transportation segment saw revenue stay relatively flat, but their segment profit and adjusted EBITDA both increased, which is a positive sign. It looks like they're getting more efficient in this area. However, what's really eating into their profits at the corporate level are these unallocated costs. For the first 6 months of 2025, these costs jumped to $145 million, up from $443 million last year. And here's a key point. They mentioned $25 million of direct response costs related to that cyber event earlier this year. That's a significant hit to their overall profitability. Let's look at new business. Total signings, which is basically the estimated future revenue from new contracts, surged from $515 million in the second quarter of 2024 to $800 million this year. That's a massive 55% increase. And new business TCV, total contract value, also jumped up significantly. It seems like they're winning more deals, especially renewals, which are up a huge 94%. This is a really strong indicator that their sales teams are performing well and landing new business. But when we look at net LR activity, which tries to account for losses and changes in existing contracts, the picture gets a bit murkier. For the trailing 12 months ending June 30, 2025, this metric is $63 million, down from $116 million just 3 months prior. This suggests that while they're signing new deals, they might also be losing some business or seeing declines in existing contract values. Looking at the cash flow, the company used a more significant amount of cash in operations this period, $73 million, compared to $78 million last year. While both periods used cash, the increase isn't great, but remember, they've also sold off a lot of their businesses, so this is expected to some degree. The big story in cash flow is the massive drop in investing activities, primarily because the major proceeds from selling businesses happened last year. This year, they're only seeing a fraction of that, which is a clear sign that their divestiture strategy is largely complete. And in financing, the cash used is drastically lower than last year because they've already done a lot of debt repayment and share buybacks. So they're in a much more stable financing position now. Now, let's talk risks, and Conduent has a pretty big one front and center in their filing. They're heavily emphasizing the risk of cybersecurity threats. They specifically mention that their systems have been and may continue to be subject to hacking and other cyber threats. And this isn't just a general warning. They admit that in January of this year, they had a cyber event where a threat actor gained access and stole client data. While they say they fixed systems quickly and the disruption wasn't material, the fact that they're calling out this data exfiltration as a major risk and even mentioning $25 million in specific costs related to it in their SG&A shows this is a serious concern for them. It could lead to lawsuits, regulatory fines, and damage to their reputation. On a more positive note, Conduent's board approved a new share repurchase program, authorizing them to buy back up to $50 million of their stock. This is a sign of confidence from management, suggesting they believe their stock is a good investment. So what's the verdict on Conduent? They're clearly in a transitional phase. The divestitures of businesses like Benefit Wallet have cleaned up their portfolio and likely made them more efficient, but it's also led to significantly lower revenue and a shift from profits to losses in the short term. The strong increase in new contract signings is a very promising sign for future growth, but the cybersecurity risk and the rising unallocated costs, especially those related to the cyber incident, are significant headwinds. They need to keep a very close eye on those costs and bolster their defenses because a major breach could really derail their turnaround. It's a company that's shedding baggage and trying to grow, but they've got a lot of work to do to prove they can thrive in this new, leaner structure. Alright, that's our deep dive into Conduent's latest quarterly report. What's your take on these numbers and what they signal for the company's future? Do you think their new business wins will offset the losses from divestitures and the cybersecurity risks? Let me know your thoughts in the comments below. If you found this analysis valuable, please hit that like button to support the channel. And of course, subscribe for more corporate decoding. Don't forget to join our Discord community. The link is in the description. Thanks for watching, and we'll see you in the next one.